the United States corporate tax landscape underwent a dramatic shift in 2018. The Tax Cuts and Jobs Act, or TCJA, introduced sweeping changes that reshape both corporate and individual tax structures. These reforms have had far-reaching implications for businesses, individuals, and the overall economy. At the heart of the TCJA was a significant reduction in the corporate tax rate. Prior to 2018, corporations faced a graduated tax system with rates ranging from 15 to 35%. The TCJA simplified this structure, introducing a flat corporate tax rate of 21%. This change not only lowered the tax burden for many businesses, but also streamlined the tax calculation process. The individual tax code also saw substantial modifications. The TCJA restructured tax brackets and rates, generally lowering tax burdens for most filers. The new system retained 7 tax brackets, but adjusted the rates and income thresholds. The top marginal rate decreased from 39.6% to 37%. These changes are set to remain in effect through 2025. Other notable changes for individual taxpayers included the elimination of personal exemptions and the doubling of standard deductions. The child tax credit was expanded, and various other credits and deductions were altered. These adjustments aim to simplify tax filing for many Americans, while potentially reducing their overall tax liability. When considering corporate taxes in the United States, it is crucial to account for both federal and state-level rates. While the federal rate is now a flat 21%, state corporate tax rates vary significantly. Some states, like Wyoming and South Dakota, do not impose corporate taxes at all. In contrast, states such as New Jersey and Iowa have corporate tax rates exceeding 9%. When combining state and federal rates, the effective corporate tax rate can surpass 25% in certain states. From an international perspective, the U.S. corporate tax rate is now more competitive. The federal rate of 21% falls below the average corporate tax rate of approximately 23% among OECD countries. Even when factoring in state-level taxes, the effective U.S. rate aligns closely with international averages. This shift has implications for global competitiveness, potentially influencing business decisions on where to locate operations or invest. The impact of these tax changes on businesses has been multifaceted. Large corporations have generally benefited from the lower flat rate, potentially freeing up capital for investment or shareholder returns. Small businesses, while not directly affected by the corporate rate change, if they file as pass-through entities, may benefit indirectly from overall economic growth, stimulated by increased corporate investment. However, these tax cuts have also had significant implications for federal revenue. Estimates suggest that the reduction in the corporate tax rate has decreased annual federal tax collections by around $135 billion. Proponents of the tax cuts argue that increased economic activity and investment could potentially offset these losses over time, though the full long-term impact remains to be seen. In conclusion, the 2018 changes to U.S. corporate tax rates and related policies marked a significant shift in the American tax landscape. The introduction of a flat 21% federal corporate tax rate, combined with varied state-level rates, has reshaped the tax obligations of businesses across the country. These changes have positioned the U.S. more competitively on the global stage, while also impacting federal revenue and potentially stimulating economic growth. As we move forward, the long-term effects of these policy changes will continue to unfold, shaping the economic landscape for years to come.